in inflation. The red one is the core inflation. Black is our policy rate, and then dotted line shows our medium-term target range of 5 to 7%. So in September 2001, as you know, we started tightening monetary policy. We reached to 22% by June 2023, and then we stayed there for quite some time, almost a year. And then the policy rate started to come down as the inflation was coming down, and monetary policy committee were more getting more confidence that inflation is heading towards the medium-term target range. So the assessment is that monetary policy did play a very important role in guiding this inflation and ensuring a downward trajectory in the inflation, which is now very close to the upper bound of this medium-term target range, around 7.2% in October, and core inflation, which is the red line, is also coming down. If we go on the next slide, this shows the composition of this journey. So if you look at all three components have shown this has contributed to this deceleration in inflation. If we focus on the last 3 months, August was the number that we had when we met last time for the monetary policy and this analyst briefing meeting. It was 9.6%. Then it came down to 6.9%. And October number, as I said, is 7.2. So it has come down significantly, and it was more than the expectations monetary policy committee had earlier. And there are a couple of factors that we also mentioned in our monetary policy statement, which led to this sharper deceleration of inflation, which include the food prices and also the energy prices globally that has come down. So, and government has passed on those to the domestic consumer. So that has also helped. Core inflation continued to decline as per the expectation. So all three components have contributed to this deceleration in inflation. If we go on the next slide, which is showing the food inflation, and the figure 1, we have month-on-month inflation, and compared to its historical average, roughly is around 1%. Whether you exclude wheat or include wheat, so it's roughly now very close, moving very closely. And the figure 2, we have shown you the contribution of different 2 categories of the food item, perishable and the non-perishable. The perishables are shown in the yellow bars, while non-perishable contribution is blue. So the food inflation, both perishable and non-perishable, has come down quite significantly, and that's contributing to this deceleration of inflation. The stocks are good. Last year we have very good production of different crops, food crops. So that is helping. Food inflation, of course, this volatile component, monetary policy committee has taken note of this and assessed the inherent risks that are there, and consider the current policy rate after the cut of this 250 basis point and 15% is appropriate to mitigate any such risks which come from either the food prices or in the energy prices, or any fiscal measure that government can take. If we go on the next slide. So that is showing the inflation expectations. As the inflation was coming down, the oil prices were coming down, and the month-on-month inflation, which consumers are now observing, so their expectations is also declining. The business expectation has also come down, but if you look, both these lines were very volatile. But in the last 2-3 waves of surveys that we did, so inflation expectation of both consumer and the businesses are coming down. In the figure 2, this is most of you contribute. It's an inflation expectation for forecasters, different brokerage houses, the analysts we have in different banks. So they are contributing. We have increased the coverage of this as well. So now a number of analysts also start believing that inflation would come to this target range which was not the case 6 months ago or a year ago. So that inflation expectation is these are still high. 2-year ahead projections. This show the average, but increasing number of analysts are now also start believing that inflation will come to the target range, and this is what the commitment monetary policy had, that they will deliver on this inflation to bring down to the target range. If you're going next. So what's happening on the growth? So growth is an annual graph. So range is same, 2.5 to 3.5. What we have shared with you in July, after the July monetary policy meeting. So it remains the same, but within that, our assessment, early assessment, since the new data is available, so that is showing an encouraging picture. So it is expected to be better, though while remaining within this range. And there are mainly, if you go on the next slide, this show the heat map of the industry. So, and these are arranged in order of weight. So heavyweight items are shown at the top. So we see the textile, food, POL, chemical, they are showing recovery, and we expect this to improve further. It's turning out the outcomes of the August and July were turning out better than what we were anticipating earlier. We're still on YY basis. This shows small negative number, but we expect this to improve when the leading indicators are suggesting that. If we go on the next slide, it shows the business and business confidence diffusion index. So if you are at 50, which means the positive and negative views that we are getting in the survey are equal. If it's above 50, which means that positive or a better confidence, the higher number of respondents are giving positive response. So, or improving industry or the business condition. So if you look at the figure 1, this is for the industry, and figure 2 is the services. Both are telling the same story, but services, it is slightly above. It has been quite some time, and it's improving, and this is expected also to contribute. So if you go on the next slide, we have the latest data available for the first estimate from the Federal Committee of Agriculture, FCA. So here in this chart, you can see what the FCA target for the FY25. So sugarcane turned out significantly better than the target set for this year. Similarly, the rice is on the higher side compared to the target. And there is some shortfall in the maize and cotton. Cotton, we were perhaps expecting this based on the cotton arrival data that we were looking at. But overall, if we have a combined effect on the kharif crops, it is showing slightly better. It turned out slightly better than what we were anticipating or taking an earlier assessment for the FY25 growth. If we go on next slide, so growth is improving, inflation is coming down, and at the same time, our external sector and the macroeconomic stability indicators are showing improvement. Here on this graph, these are the external sector variables. The first figure, we have FX reserves. You can, I'm sure you're following this data. So we weekly update our FX reserve on our website. So now the FX reserve have reached to around 11 billion. And we remember in January 2023, it was as low as 3 billion. So it's improving. And now we have also IMF program up and running. So that will also improve the prospect of receiving more inflow. So far, if you're following the balance of payment, financial inflows remain moderate, but is expected to increase in the coming month as well. In the figure 2, we have the forward swap liabilities of the central bank. So that has also come down from its low of, for example, 6 billion mark around January, February. So now it's around 3 billion. So that is also improving, which also shows the the quality of reserves. So these are not because of this by increasing the liability book. Rather, if we had not reduced it, reserve would have been even higher. And as I mentioned earlier, we have so far we have not received much of the foreign inflows or the offshore inflows which were planned for this year, which are expected now. So they will further boost the reserve going forward. And all in all, this is reflected in on the exchange rate, which is on the figure 3. So in the past few years, we have seen significant depreciation, and now the rupee has stabilized with improved external fundamentals, with improving reserves, with reducing liabilities, and also very minimal spread between the interbank and the open market trade. So all these indicators are singing the same song and showing the improvement in the external account. And what is driving? So one of the important factor is the current account. And here we have shown you monthly data, but on the top you can see the annual number as well. So in FY22, it was 17.5 or 4.7% of GDP. In FY23, it was reduced to 3.3 billion or 1% of GDP. Last year, it turned out 1.7 billion and or 0.5% of GDP. And in the first 3 months of the current fiscal year, the current account is hardly 100 million. Worker remittances are playing important role, which are shown here in the green bar on the top, which are more than which are offsetting the trade balance and also the primary income balance, and keeping the overall current account deficit at a low level. Our economy, as I said, economic growth is recovering, so we expect imports to grow, but at the same time, the worker remittances remain strong and exports are growing, so that are keeping a check on the current account and helping us building reserves. If we go on the next slide, there's some more detail on what's happening on the exports. So far, so in the figure 1, these are annual data. If you look at the last 2 bars, which is shown in blue, are for July-October data for last year and this year. So in July-October, so far, we have seen the growth of around 13.5% in the exports. And then figure 2, and this is based on the PBS data. And if you look at the figure 2 and 3, so they are showing you the volume index and also the value of these commodities. So you can see in the second figure, the high value textile, their volumes continue to grow. All other import volumes are also up over the last year, but still at the level that we have seen in 2019. And then rice, this has been volatile, but is improving. So far, we have seen good growth in the overall rice exports. It's continuing. And one of the factors that has helped is not only the good domestic production, which was more than what we have for what we need for our domestic consumption. And this was helping us have surplus and exporting in the international market. We do see some decline in the prices going forward because now India has lifted the ban, but overall export of rice we see will continue to good moderate growth. It would be less than what we have last year, but better. It's going to improve in the as this is mostly seasonal. So the season starting, so we foresee that rice export would improve in the coming month as well. And then high value textile and all other imports are also reaping better unit value now. It's continuing, so that also gives the comfort that export will continue to grow. If we go next slide, we have the similar analysis for the import. So far, import in the PPS data show around 5% growth. Oil prices, as you all know, has come down. So that is helping, which is in the figure 3. And also the other commodity prices are helping. the global price is low. But when monetary policy discusses, they do take into account the volatility in these prices and the risks that we have. So to taking the decision considering all these risks. If we go on the next slide, this is showing the another indicator which is showing an improvement. So look, this is external debt of and liabilities of Pakistan. The red line shows the total debt, which include private and public, mean total debt and liabilities of the country. The blue one is the public debt, and the yellow is the government debt. All three indicators, if you look at, were increasing significantly in the past, I would say past 10 years or 9 years. So they were growing until 2022. And then since then, if you look at, for example, if you focus on the public debt, so that was 100 billion in June 2022, and now it is at 98 billion in June 2024. So that has not increased. And our reserves, we have been able to build reserves without these liabilities. If we go on the next slide, and I think this is where I think which is more important, I will spend some time on this. I think, and as I mentioned, like if you compare June 2002 composition of debt, public debt, and with the current level of June 2024, so what it shows. The blue one is June 2022, and the green bars are June 2024. So all debt has somewhat declined from 100 billion to 98 billion. But what is important, if you focus on the bottom panel, which is the multilateral and bilateral, so their loan has increased during this period. The other component which has increased, the bilateral, which is the second from the bottom, and then some increase in the other central bank deposits. So what has come down? The commercial loans, which is third from the top, and the sukuk we have repaid in the last 2 years, and we have been paying to Paris Club. So these are the items which are declining, but the commercial loans, Eurobond. So we have paid these maturities, and now the commercial loans which are left is around 5.5 billion, and these are those loans which are mostly negotiated on G2G basis, government to government basis, and these are either rollover or refinance. So in that, bottom line is that our debt composition is improving, is lengthening. The risk of rollover is coming down, because now most of these loans are the one which are bilateral from the friendly countries, or multilateral, which are really long term, and also have interest rate which is much lower compared to the commercial loans. So despite all this, we have been able to improve our reserves. And if you go on the next slide, these are not our calculation. This is the table. This graph is coming straight from the IMF staff report, the recent report which was published in October 2024. And this shows the gross external financing requirement as percent of GDP. So you can see in FY22, our requirement was 9% of GDP. And then it's gradually come down. Last year it was around 5.4%. And then now this year, IMF is expecting 4.7. Here, the gray is amortization, and blue shaded bar is the current account. And here, as I said, like this is all IMF numbers. IMF was expecting current account around 1% of GDP. Our projection, as you know, we showed you earlier as well, we informed you that it would be between 0 to 1%, and we are not in a very, extreme risk scenario. It can go to 1%, but you have seen what the number for the first quarter is, and is expected to be much lower than that. So even our gross financing requirement could be lower than what IMF is projecting here. So our gross financing requirement has come under 5%, and it is expected to improve further. So with this, let me turn to the other important policy measure which has helped and important and have played important role to supplement or to support the monetary policy is the overall fiscal stance of the government in the last few years. So if you look at the first figure, the blue bars are showing the overall fiscal deficit and gray are the primary balance. So the overall fiscal deficit has been coming down. Government is targeting around 5.9 or 6% of GDP this year, and their primary balance, what they're targeting is 2%. If you look at the figure 2, so this fiscal deficit has improved, and that has also helped bringing government debt as percent of GDP from a high of, for example, 76.6% in FY22 to 67.2% at the end of last fiscal year, FY24. And if this trend continues, the government is targeting, it is expected recently released. And in the figure 1, we have the fiscal and the primary balance. So compared to last year, there's significant improvement. And one factor which explains this, the significant improvement of the record improvement, is the central bank profit that has been passed on to the government, 2.5 trillion rupees. So that's you can see in the figure 2. So the major difference compared to last year is coming from the profit, and that has already been transferred to the government and reflected in these numbers. But even if you exclude those the profit from both FY24 and 25 and do this analysis, the fiscal indicator is still showing improvement, both primary and as well as the overall fiscal balance. And that you can see in the figure 3, the expenditure composition in the first quarter. So non-interest expenditure has somewhat slightly increased percent of GDP. Interest component has come down by about 20 basis point, and then government expenditure slightly shrank. So so this is the composition that we have so far in the Q1. What monetary policy think is that it's very important that we continue on this fiscal consolidation path, and this has been helping containing demand economy, improving the economy, and this is where so we have seen that in the first 4 months the revenue is slightly down, but it is the measures that continuing measures government have. It's important this revenue improves. So if you go on the next slide, this shows the monetary growth. So broadly, the money supply is roughly the same, around 15%, so slightly increased. And in terms of composition also, NDA has been the main driver, but NFA has a positive contribution in the M2 growth that we have seen so far. And in the figure 2, we are showing you the liability side composition, where currency in circulation start showing some positive contribution in the M2 growth, and but deposit continue to remain the mainstay of this M2 growth. But in relative term, now the currency deposit ratio is showing some uptick, but better than what we have last year and in the similar point in time. So if you go on the next slide, this shows the composition of NDA within the money supply. It has changed significantly. So after receiving this SPP profit, as you know, the government has reduced its borrowing requirement. They have also started the buying back operation of the outstanding securities. So that has reduced government borrowing from the banking system or commercial bank or from the market. At the same time, banks are now giving more credit to the non-government sector. So because of the reduced requirement, the liquidity is available with the banks. So the banks have paid back some of the open market operations or the liquidity they were borrowing through open market operation. The stock has come down, but at the same time, they've also started giving more credit. We know there's there's a tax elevate related to the advances deposit ratio of end December. So that is also creating incentive for the banks to extend more advances to non-government sector. And that is reflected here in the gray bar. If you go on the next slide, I think you can see that more clearly, which shows the credit to private sector YOY growth. It is bottoming out and started accelerating. So interest rate have come down. As I said, like government has the liquidity, so they had reduced their borrowing requirement, and bank were pushed because of this end December ADR as well. So all these components with economic recovery are contributing higher credit, which has started increasing. And in the figure 2, we have this policy rate and also the weighted average lending rate. So those have also come down. So with this, what are the key takeaways? I think the economy as such is heading in the right direction. Tight monetary policy is working. We are seeing recovery in economic growth, but so far we have been able to bring down inflation. We have been able to accelerate the growth somewhat, and this is not accompanied with the pressures normally we have seen in the past. So on the external account, we are building reserves. And as I said, like monetary policy has been supplemented or supported by the fiscal stance. Debt indicators are showing improvement, and overall monetary growth remain contained and distribution is improving. So let me stop here. Over to you, Nusa.
Thank you, Amin sir. So before we go into the Q&A session, I would request Governor Mr. Jameel Ahmed if he would like to add on top of the information deck, or should we go into the Q&A session? Sir.
Yeah. So thank you, Noor Saab, and good morning and afternoon to everybody. Maybe I can just update on 2-3 points and then we can go to Q&A. First one, as usual, on the external debt payments. As I have been updating in the previous such briefings also, that we have for the current fiscal year 2025, we have total serviceable debt of 26.1 billion, including interest. Previously, it was 26.2, but because of some interest adjustments, so it's 26.1 billion total for the year. And out of that, 5.7 billion has already been serviced, including rollovers of 2.3 billion. And for that, documentation etc. has already been completed. So this leaves us for the remaining amount of 20.6 billion. And out of that, we, as I said for previously also, that for the full year, there are rollovers of around 20 or around 16.4 billion. So out of which 2.3 billion has already been executed. So there will be further rollovers of 14.1 billion. And this will leave us to repayable remaining amount of 6.3 billion. So for the remaining 8 months, we actually will be required to repay 6.3 billion. And the rest of the either has already been rolled over or will be rolled over going forward. This 26.1 billion includes interest payments of around 4 billion and principal of 22.1 billion. The second update is on the total overall debt stock. As you have seen in the data which we have been publishing, that total overall external debt has somewhat been reduced from 2022. So in June 2022, it was around 100 billion public debt, which was total outstanding at that time, and this has come down to 98.2 billion. So there is actually a reduction of around $2 billion in the outstanding debt of the country. And also a related development is that there is a significant change in the maturity profile of our external debt also, because previously the overall debt stock included sizable outstanding amount of short-term debts also, which has already been repaid, and now we are left. That has been replaced with the multilateral long-term debt. So as a result of that, the debt profile has and its maturity profile has changed over a period of time. But the important thing is that despite our heavy debt repayments during the last couple of years, our overall debt stock has come down by around 2 billion instead of increasing. As you have seen before 2022, during the last 5 years, between 2017 and 2022, the external debt has increased on average by 5 billion every year. But for the last 2 years, it has come down by $2 billion. On the domestic debt side, again, there is a change in the maturity profile. The total domestic debt included around 24% of short-term treasury bills for the fiscal year 2024. And for the first 4 months, we have been able to bring, government has been able to bring some improvement in that. And as a result of that, now the short-term T-bills has come down to around 21% of the total domestic outstanding debt. And we are hoping that for the full current fiscal year, it will go down to less than 20%. So, and that has been replaced by the relatively longer term debt maturity. So this is also changing the profile of the domestic debt also. On the debt servicing side, as you have seen in the last budget, the government has budgeted total of around 9.8 billion Pak rupees as interest payments for both domestic and foreign debt. And as a result of reduction in external debt stock, as a result of exchange rate stability, as a result of some recent buybacks by the government, so all that, and also the policy rate revisions. So the government external debt servicing cost is expected to substantially come down. So as against the budgeted amount of 9.8 billion rupees, we are expecting that it will be less than 9.8 trillion rupees. We are expecting that it will be less than 8.5 trillion rupees. And as you know, last year's full year interest payments were around 8.2 billion. So it will be slightly higher than last year, but will be very close to the last year's payment. But our current assessment is it will be less than 8.5 trillion for the full fiscal year 2025. On the outstanding debt, both domestic and external as a percentage of GDP, it was at 75% as of 30th June 2023. And as of 30th June 2024, it has come down to 67.2%. So in terms of GDP, you can see the overall debt stock of the country has significantly come down. On the debt servicing cost, at the time of budget for current fiscal year, it was estimated that the total interest payments will be around 60% of the government tax revenue. And now we are assessing that as a result of substantial reduction in the interest payments expected for the current full fiscal year, the interest payments as a percentage of revenue, tax revenue, will go down from 60% at the time of budget to less than 50%. So I just wanted to share this data because these are the significant developments so that it can facilitate your analysis as far as the country's debt stock and its related debt servicing cost is concerned. On the external side, as you have seen that the current account has been in a very manageable shape. It has been only less than 100 million for the first 3 months. For the October month, although we have not yet compiled the final data, and we are hoping that it will be released over the next couple of weeks. But I can at this stage share with you that the trend in the remittances is very healthy, and it's in line with the previous trend which we have seen for the last around 6 months. So for October also, we are hoping that based on the inflows which we have received on daily basis, we are hoping that remittances will stand above $3 billion. And as a result of that, the overall current account for October will also be in good shape. But we will share the data in due course once it is finalized. So with this, maybe we can have question and answers.
Thank you, Governor Saab. So for managing the Q&A session efficiently, I would request that you may post your questions in the comment box or use the raise hand option. As always, we are in receipt of advanced questions, so I would request Governor Saab, if we may take the advanced questions first.
Ji, please.
Okay, thank you. So in the interest of time, we have organized these questions into sets of questions, and the first set of questions is on the inflation and policy rate outlook. So I'll just read out a couple of questions with your permission for you to respond, sir. The first set of questions is by Mr. Muhammad Shayan, Bank Al Habib, and Mr. Hassan Raza, NBP Funds. And the question is on the aggregate demand and the real interest rate environment. The question goes like, with the of shrinking across sector, SPP intend to keep a restrictive monetary policy stance. Restrictive policy stance. The part of this question is, can you please compare across regions where central banks are running real interest rates that are as high as they are in Pakistan? And also, what is necessitating such elevated policy rates? Should we take more questions, or
maybe I can
like
respond these two questions? So on the first one, how long to maintain the restrictive monetary policy stance? So this is not a restrictive monetary policy stance as such, I will say. It's a stance which we say is a prudent and cautious approach, and it's aligned with our local economic fundamentals and overall macro economic developments which we have. So so there is no timeline as such for maintaining this stance. So we at the Monetary Policy Committee level continue to review all the developments on the macro economic and there is no single factor which is taken into account, as I have been the past policy committee, and based on that they take it. So as there is a timeline, we will continue to monitor for both on inflation side as well as on external side, in addition to factors which are taken into account, and based on that a decision is taken. And from time to time, we will keep a look at all these factors and then take a decision. As have seen today, we recent developments and also on the inflationary current inflation as well as inflationary expectations, and also very comfortable position on the external side. So all those factors have been taken into account and duly reviewed by the Monetary Policy Committee, and then they decided to have this relatively big cut as against our previous decisions. And going forward also, because at this time there is more clarity on number of factors, that is when the budget was being formulated. So so going forward also, we will continue to review the position and then take appropriate decision. Second question regarding the regional comparison. So I think we should not be as such making regional comparison, although we do take into account the developments in both in the advanced markets as well as the regional countries. But every country has its own fundamentals, and they have their own compulsions. Some countries, they have a higher level of reserves. They have more balanced current account position. So they have, and similarly, they have more different dynamics of their inflationary trends. So they take decisions in their own environment. But as far as we are concerned, we have to take into account the factors which are relevant for us. As also we have to take into account the external account situation. Also, we have also to take into account the low level of reserves which we have, and based on that, then we have to take a decision. And that's the reason we have been following a cautious approach. And we will continue to maintain that monetary policy stance so long as our fundamentals are not further strengthened, and we are more on solid footing. So we are not as such making any comparison with the regional economies for taking our monetary policy decisions.
Thank you, Governor. So I'll read out the next two questions from the advanced questions. Next question is by Mr. Shan Sheikh HBL, and it is on the contribution of wages. So the question is, it is safe to say SPP will weigh core inflation projections and contribution from wages more than headline readings in their assessment for monetary policy decisions? Moreover, can you provide an estimate or range of the neutral rate or the long-run growth potential of the economy? Sir, if you allow, I can also read out the next question.
Yes.
Okay. So the next question is by Mr. Arun Kumar, JS Bank, and it's on the geopolitical risk. The question is how SPP is evaluating geopolitical risk and increase in inflation from May 2020. And onwards in this decision.
So on the first question, wages so it's duly taken into account before arriving at any decision, obviously along with other relevant developments. The second question about the estimate of neutral rate. So I think, as I said, we are not tracking any particular indicator, but we do review all the relevant factors. So as such, there is no target for neutral rate and our estimate. So we do take into account the current developments as well as the forward looking trend and expectations for inflation, and also the impact of our current decisions on going forward on various macro factors, particularly on the inflation and external account. So then we arrive at a decision. So as such, we are not having any particular estimation as far as the neutral rate is concerned. The third question about the geopolitical risk. So these are, again, a key factor which are reviewed by the Monetary Policy Committee. And we do take into account the current developments on that front also, and various analysis which is being conducted is. And particularly, we focus on the impact of these developments on the oil prices, international oil prices, and ultimately its impact on our current account and balance of payments. Because of the reason that we are a significant oil importing country, and any adverse development on that front will have a significant impact on us. And that's the reason this is one of the key indicators which is taken into account. Good thing is that as per our current assessments, we still have a much cushion available because we are factoring a relatively higher price when we do our assessments. And that's the reason any fluctuation at this stage, I can share that any 10 to 15% fluctuation in the current on factored into our assessments. So if it is beyond that, then it will be a risk which we have not factored at this stage. So for the time being, we are taking that into account, not just on the oil, but also the second important item for us is the commodity prices, edible oil and other similar commodities which we import. So we do take into account the impact of geopolitical developments on those prices and factor in our assessments.
So I have some questions in the chat box as well. So if you allow, I can pick up a couple of questions from here, which are related to monetary policy, rate and outlook. You may have answered that. We may skip some of these questions. So the question by Mr. Mohammad Saad Ali, Intermarket Securities, is that what is the SPP's revised range for inflation, average inflation across FY25? I can read another question, sir.
Yeah.
It is with regard to, of course, banking, but it's by Mr. Adil Mansoor. There are two questions. So, to what extent is the rise in banking sector advances during October 24 attributable to the ADR phenomena? Does SPP expect credit growth to slow down in coming months? And there's part two to it. How much of outstanding under EFS scheme is now refinanced under Exim Bank loan, and can SPP share a breakup going forward? So I'll take a pause for you to answer these questions.
So on the first question, revised range of inflation. So as you have seen in July, we normally, as per past trend, we normally share our assessment on the expected average rate of inflation for the current fiscal year, first time in July, and then we revise it in January. So yes, we have been assessing, but we will share the revised range in January meeting, post January MPC briefing. So for the time being, we are assessing, but we have been giving you an indication for that. And as we said in the statement of today also, that we are now expecting that the average rate of inflation for the current fiscal year will be below than the range of 11.5 to 13.5, which we have shared in July last. So it will be lower than that, but where exactly it will be, we will share the revised assessment in January. The second question about the rise in advances due to ADR. So yes, ADR is a contributing factor in the recent increase in advances to private sector, but this is not the only factor. There are other developments also, as you have seen in the recent past, particularly the government appetite for further borrowing. There is a change in that, and also there is a change in the borrowing profile also, because they have relatively focused on longer term borrowing as against previously only the short term T-bills borrowing. So and also revisions in the policy rate, which has squeezed the margins of the banks. So banks are now making more concerted efforts to increase their loan portfolio, and that's partly just because of meeting the ADR targets also, but there are other factors also, which are now being looked into by the banks. And that's the reason they have also recently started on marketing of certain consumer products also. And they are reaching out to SMEs and other borrowers also, particularly of good quality borrowers. And they want to increase for the month of October is also there, because there is a significant pickup in advances to private sector during the month of October. And let's see, we are hoping that this trend will continue, but it will be more visible with the first quarter of next fiscal year, next calendar year. Lastly, on the EFS, so on the export refinance scheme, as you have seen, we have given a 5-year roadmap for transition of export refinance scheme from State Bank to the Exim Bank as a part of the commitments which we have given to the IMF. And under this 5-year transition plan, we will be gradually transferring from the export refinance scheme from State Bank to the Exim Bank. For the fiscal year 2024, 10% of that, of the outstanding amount was transferred. At that time, the outstanding amount was 770 billion. And out of that, more than 20% has been transferred to the Exim Bank during fiscal year 2024. And for this year, we have committed to transfer another 20% of the outstanding amount. So, and similarly for coming years also, we will continue to do that. So by the end of 2028, the entire scheme will be transferred to the Exim Bank. And in addition to the outstanding amount which is being transferred, the government has also made some budgetary allocation, and as a result of that, the Exim Bank will be providing additional, I think, around 250 billion rupees. So total export refinance to be extended to borrowers for the current fiscal year is more than 1 trillion. So the target is that both Exim Bank and State Bank combined will be providing more than 1 trillion rupees to the exporters for the current fiscal year.
Thank you, Governor. So the next set of questions is on exchange rate and foreign exchange liquidity. If you allow, sir, I can pick up a few questions. We have couple of questions in the advanced part and some are in the chat box. So the first set of questions is by Mr. Hassan Raza, NBP Funds, and Mr. Shan Sheikh, HBL. The question is, according to IMF staff report table 3B, IMF has estimated cumulative BOP gap of around $2 billion during FY25 and FY26. First of all, please clarify what is SPP stance of this, and secondly, can we elaborate why IMF believes that SPP is facing this funding gap? And lastly, how much funding gap exists for the duration of the IMF program? So these were questions. If you allow, sir, I can pick up a question from the chat as well on a similar topic to club them together, sir.
Yes.
Okay, sir. Thank you. So the question is by Muhammad Ehsan. It goes, can you please give the breakup of sources of 3.7 billion central bank deposits liabilities as of June 2024? What is the interest rate paid on these? Is the rate floating and hence moving lower with the federal rate cut? Sir.
Yes. So on the first one, a financing gap on external financing. So as such, there is no financing gap. Even as far as the IMF assessment was concerned, they initially assessed some gap, and as a result of that, the government has already arranged financing for that, and it was more than $2 billion. So that's the reason the fund was able to present our case to the IMF board, and it was approved by the board, because till that time the alternate financing arrangement was not made by the government. The case was not presented. So that's the reason you have seen that there was some delay in that also. But as far as we are concerned, from the State Bank side, there was no gap previously also, because of the reason that our estimates for current account deficit were quite different as compared to what the fund was assessing at that time. And after arranging this additional much more than $2 billion by the government, there is absolutely no gap. As per our assessment, there was not gap before that also. And you have seen this during the first 3 months of the current account deficit, because the current account deficit is quite low when compared with the IMF expectations. And also we have assessed right from beginning that current account deficit for the current fiscal year will be on relatively lower side. And that's the reason we have given a range of 0% to 1% of GDP. And for the first 3 months, in fact, the fourth month will also be same trend. And the current account for the first 4 months will be quite negligible. And for the full fiscal year, it will also be within our range. So that's the reason we are not seeing any gap as far as the external financing is concerned. And that is also reflected in the increase in SBP reserves, because the SBP reserves at the end of June 2024 were $9.4 billion. And as you have seen, it is already increased to $11.2 billion last week. And in addition, there is a inflow of $500 million, which has already been approved by the ADB, and it is on the way. Once the procedural formalities are completed, we are hoping that it will be received maybe within this week or maximum next week. So this will raise our reserves to $11.7 billion from $9.4 billion. So this is a more than $2 billion reserves increase, despite heavy debt repayments which we have made. And I have shared the numbers already with you, that we have, in addition to the rollovers, we have made actually repayments of around $3.5 billion during the first 4 months. And despite that, our reserves have increased to next week. By next week, it will be around $11.7 billion. So this reflects that as such, there is no gap, and we in fact will be performing better than even the initial assessments. And already we have shared in the last MPC briefing that our reserves by the end of June 2025 will be well above $13 billion. The second question was about how much funding gap during duration. So during duration of the program also, as such, there is no gap. All those arrangements have already been put in place. And important thing is that our bilateral partners have already given assurance to the fund and to the government of Pakistan also that they will continue to maintain the existing level of exposure over the program validity for which is 37 months. So with that, the significant part of our maturing debt repayments will be rolled over, and the remaining amount will be quite low, and we'll be able to easily service that. In fact, we'll be able to increase our reserves also during this period. And if you have seen the IMF report also for the end of fiscal year 2026, IMF has also projected that our reserves will be above $15 billion. The last question about the 3.7 billion central bank liabilities and the rate offered on that. I think you are referring about the swap which we have done in the interbank market. So as such, there is no specified rate because those liabilities are rolled over as they mature. These are short-term liabilities of the state bank, because we have entered into swap arrangements with the local banks. And as and when they mature, those are either rolled over or settled. So as such, there is no rate associated, but those transactions are closed on the prevailing market rate. Yes.
So thank you for comprehensive responses, sir. So next set of questions, if you allow, sir, we may go to monetary policy implementation and transmission. So the question regarding the implementation is by Mr. Hassan Raza, NBP Fund. The question is the secondary market yields of even short-term papers and the 3 months and 6 months KIBOR rates are showing a permanent disconnect from the policy rates set by the central bank. It appears that the policy is not serving as an anchor and transmission of monetary policy is not as effective. What are your thoughts on it? Sir, with your permission, I will also request you to answer a couple of questions from the chat on similar issues regarding the transmission of monetary policy. The question is posted by Mr. Ali Khizr. It's when will the SVP end auto loan limit of rupees 3 million? And the second part is, isn't government tax on low ADR distorting monetary policy mechanism? So I'll take a pause for you to respond to these questions.
So on the first question regarding the deviation, so this is not the case with the Pakistan. If you have been following the monetary policy developments in other countries also, so there in other countries' case also there have been deviations between the secondary market yield and the policy rates of the country. So it depends upon the market fundamentals. Sometimes it's above the policy rate, sometimes it's below the policy rate. So since in our case, the market developments recently are such that the banks going forward expect the inflationary trends to be on low side, and that's the reason they are trying to factor in their assessments, and they are quoting rates which are quite below the policy rate. So it's not an unusual phenomena, I will say. It's in the case of other central banks also, the policy rate and secondary market yields deviates from each other. The second question about the auto loans, I think already, if you have seen the trend in recent periods, the auto loans have already picked up significantly, and also recently the banks have also started marketing of these products. Previously, they were not doing it, perhaps because of the high rates and also because of the low demand from the customers, and also because of the capacity of the automobile industry to service this demand. Maybe there were a number of factors, but with the pickup of economic activity and also increased demand and also affordability, I think it has already started picking up. We will continue to review the position, and but at this stage, we are not contemplating any intervention on that front. The last question about the government tax on ADR tax and its impact, I think this has the key objective is to compel the banks towards lending, because the bank lending in our case has been historically on low levels, and since obviously there are many other reasons also, but this was considered at the time of imposition of this tax that this will help in increasing the bank lending. Obviously, It has been, an issue which has been raised by the industry from time to time. But we don't necessarily see it as a issue as far as the transmission is concerned. So, we will be reviewing these developments also. And as you have seen that despite this higher rate, the banks have not been able to increase their advances previously. But now, since the market fundamentals have changed, the prevailing interest rate situation has changed, and also the economic activity has started picking up. So there is relatively increased demand for lending. So banks are now considering to increase their loans portfolio also. So if they continue to proceed on that direction, obviously, then their ADR situation will improve. And with that, this issue will be addressed. So, Noor Saab, have we done, or is there any other questions?
Thank you, sir, for comprehensive responses to all the questions. And thank you everyone for participation, especially those who shared their advanced questions, which helped in time management. Sir, if you would like to make some closing remarks before we close this session.
So, Ali Khizar Saab, I have seen your comments. So, obviously, the current immediate issue is ADR, and banks are quite preoccupied in addressing that issue. But going forward, we have to see the trend in January onward. But you will see, hopefully, banks will start focusing on lending side once this issue is addressed even after that also, because now obviously they have to also look at their overall profitability, and will have to maintain that level, and the margin on government security are relatively squeezed, so they have to also find alternate options. So we will see how it proceeds after December, because immediate priority obviously is December, and to address this issue for them. But from our perspective, we foresee that this trend will continue. But I'm not sure if our assessment is right on that or not. So we will see when the new year starts.
Thank you, sir.
Maybe Noor Saab, we can close.
So we can close this session. Thank you, sir.
Thank you. Thank you very much.
No,
Thank you all of you for joining.
Thank you, sir. Thank you, everyone.